All right, welcome to this week's Taxes and Retirement Live. I'm excited about this one today. Not that I'm not excited about other weeks, but this one's a little different, as you'll see. This isn't really anything to do with taxes in particular. This is all about fees. Fees that are in the various financial products you have and use, and fees for getting financial advice. Separate and distinct from the products themselves. This is fees for working with an advisor, or at least someone who calls himself or herself an advisor. So thanks for joining. Before we start, I have the dad jokes, and I did go to a different source. I found a good spot on Instagram. I won't share it yet to give it away, but these are better than that little box of cards I had. So here we go with this week's jokes. Everyone at our wedding cried. Even our wedding cake was in tears. Yeah, I like that one. Anyone want to buy a broken barometer? No pressure. Get it? Barometer measures pressure. And finally, a sweater I bought was picking up static electricity, so I returned it to the store. They gave me another one, free of charge. That one really got to me. I don't know why. I like that one. Free of charge. That's a little science humor for everyone there. So fees. I'm going to start. This will be sort of twofold. One, I'm going to discuss the different products, different account types, investing products, insurance products, etc., and then go into the fees for advice and sort of break down how fees are structured. I'll try to touch on what's typical, what's not typical, what things to look for, and what various fees there are or aren't in the different products and accounts and services you may get. Again, feel free to chime in, as always, with questions, comments along the way. I am on a 20-second or so lag. And next week's topic may be switched, as I mentioned. It's scheduled to be all about premium tax credits for buying private health insurance on the government exchange, healthcare.gov. That may get bumped to some point later in the year because I may potentially have a special guest next week. It's looking good, but have not yet officially confirmed. So stay posted. More coming on that, but next week's schedule might change a little bit. All right, so let's start with the fees in the different accounts you may have. We'll start with bank accounts. I assume everyone knows them. Checking, savings. I'm even going to include certificates of deposits. Technically, I guess you can call them a product, but they're sort of functionally an account, all said and done. So many traditional bank accounts don't have fees in the normal sense of the word. You go to Bank of America or TD or, depending on what part of the country you're in, Bank of the West, I don't know, whatever. You open a savings or checking account. Most times there's not going to be an explicit fee to open or maintain that account. Sometimes there is. If you have a small balance or something like that, they'll charge you whatever, 10, 15 bucks a month or a quarter, I don't know. But generally you can often open up bank accounts with no ongoing fees. They hit you with fees when things happen or don't happen. Like I said, if you don't maintain a certain balance, or if you overdraft the account, or if you want to send out a wire, they sort of nickel and dime you with 25 bucks, 50 bucks here and there. But generally, banks don't have fees, bank accounts, including certificates of deposits. You put your money in, you get interest, that's it. There's no outright fee. But that doesn't mean the bank's not making money. This is important to understand, not just for banking products, but other products, as we'll see. People need to make money. That's obvious, whether it's the employees, the person who sells it, or the organization behind it. Clearly, everyone in financial services needs to make some sort of profit, otherwise their business won't exist. So yes, banks make money off of checking and savings accounts, obviously, and they do it mainly by what's called an interest rate spread. So when you deposit money in your savings, you get a paltry 0.000 nothing percent interest. The bank is paying you a lot less than what it's earning on the use of your money. So that 10,000 bucks you have in your bank account, the bank goes out, they pool up all the other deposits from other folks like you who have checking and savings accounts. They pool it up. They then use that money to go make loans to people, to buy houses, to buy cars, student loans, whatever. They're earning much more interest on those loans that they make with your money than what they're paying to you for having your deposits with the bank. That's the spread. So assume they're making 2%, 3%, whatever interest on the money that they're lending out. They're only paying you 0.0 something small. They're keeping themselves the difference. That's the basic premise of how banks make money, on that interest rate spread. So is that a fee? It depends how you want to look at it. No, it's not an outright explicit fee because you're not paying 15 bucks a month to maintain this account necessarily, but the bank is definitely making money off you by using your money. So banks technically no fees, but again, the company's still making money because it has to. Brokerage accounts. You open an account at Fidelity or Schwab or Vanguard, or doesn't matter, wherever. There's also often not fees directly associated with opening or maintaining that account, just like a bank account. But there can and will be fees for certain things, like if you overdraft, if you send a wire, if you give bad instructions for a trade, or if you have to call up and speak to someone physically to place a trade, they'll often charge you fees for that. Brokers used to charge trades a commission, a fee, whatever you want to call it, for every trade you did. It was anywhere from $5 to, I don't know, 15, 20 on the high end, if not more, if you go to some full service brokerages or something. But generally speaking, it was $5 to $10 every time you did a trade to buy or sell stocks or exchange traded funds or whatever. Almost all the custodians have since gotten rid of those trading fees. All the big names definitely did. The smaller ones, if they haven't, they probably will at some point. So that then begs the question, how are brokerages making money off your account? It comes in a few ways. One is they're also making money on the interest spread on your cash. So to the extent you have idle cash sitting in your account, they're paying you next to nothing on it. It's literally 0.01% most likely. They then lend that out and make more than that. So they're earning some fee on that. And there's also lots of, with brokerages, they're making money behind the scenes in ways you don't know and probably don't care about and don't necessarily need to care about it. So when you and all the thousands of other people who have accounts at E-Trade, for example, you all place stock trades throughout the day, E-Trade has a choice where they go and route those orders, like what facilitator to the exchange is actually going to place those orders. Those facilitators will pay eBay to funnel them those trades. So brokerages like eBay and others will get money for allocating your trades to be executed at some other market intermediary. It's all seamless to you. You don't directly get charged any of that, but that's another avenue. So I see Cody's posting here. You may have noticed that since custodians moved to zero fee trades. Yeah, so as Cody pointed out, as I mentioned, all these custodians got rid of commissions on most of their trades. That was a big source of revenue for some brokers more than others. They're making up for it now by paying you less on your cash so they can earn even more spread. Some brokers may potentially charge other fees, account maintenance fees, perhaps. Those have been pretty hard to find for a while, ongoing account maintenance fees. Maybe they'll come back in fashion, who knows? All right, so that's brokerage accounts, and that applies the same whether it's a regular brokerage account you open with after-tax money or if it's something you open up for an IRA or Roth IRA, generally the same concept. There's no fee to open it, there's no fee to maintain it, but they'll hit you with nickel and dime fees if you overdraft, if you send wires, if you whatever, and they're making money on your cash sitting in there, and they're making other money behind the scenes for how they route their trades and potentially some other ways. They still do charge commissions on some trades. So almost all regular equity or exchange traded fund trades are now zero commission. If you want to buy a bond, for example, or some mutual funds, if you buy it through brokers, they'll still charge you like $25 or something per trade to buy and sell. Some options as well, stock options that they may charge you for. Shook is asking, same with insurance companies with your money. Good question. Just hold that for now because I have, I'll be discussing insurance in a while, and I assume I'll address, what you're looking to find out here. So 1 second or a few minutes with that. Okay, so that's bank accounts, that's brokerage accounts. How about let's also discuss employer retirement savings plans, 401ks, 403bs, etc. I might actually do a separate dedicated live discussion for this with another group member, Brian Williams, who's a friend of mine. He specializes in small employer retirement plans as a manager / advisor. So he's the expert in this space. I think I'll have him on to really dig into all the different fees to look for in your 401 or 403b. Not just, whether you're someone setting it up on behalf of employees, definitely that stuff matters. But if you're an employee who has no option other than to participate in the plan or not, it's good to know how many fees there are. It's not just simply you put money in and invest it. You can be paying potentially a few percent a year in fees because the plan is paying more than it needs to or more than it should potentially, and all the different ways they stick you for fees and these things. So we'll discuss this in more detail, most likely with Brian at some point down the road. But for now, just at a high level, I'll touch on it. It costs money to run these plans. When your employer sets it up, it's not for free. They usually need outside consultants, or they outsource the whole administration of the plan completely. That costs money. There's record keeping involved. There's legal and compliance fees involved. There's auditing that needs to be done. So how do they pay for that? It comes from you, the plan participant, in one way or another. It could be an outright annual account maintenance fee that they charge. It could be some percentage of your assets that they charge. I've even seen some where they use regular funds that you all heard of and could buy separately on your own out in the world. They'll use those funds, but tack on additional fees in those funds. And I'll talk about fund fees and expenses in a minute. So you can do it that way. There could be fees for if you need a loan, like you take a loan from your 401k, you may have to pay a fee for that. If you want to call up and talk with a real person to get some guidance about your plan, there may be a fee for that. Things like that. So there's lots of ways where fees can be sometimes hidden, sometimes not so hidden with employer retirement plans. Just keep that in mind. It's not free. Generally speaking, the larger the employer or the larger the plan, the more people that are in it, the fees will often be lower per participant, per head count, because there's a certain amount of fixed fees these plans need to have to cover their administrative overhead and record keeping and whatever. So the more people in the plan, the more you can spread that cost out, that fixed cost at least. So not always, but usually the larger plans are cheaper per participant. If you work at a small employer that has 10 people, there's a decent chance that the fees could be relatively high, especially on a per person basis in your employer retirement plan. So Brian Williams just commented. He's the one I mentioned. He's the retirement plan expert here who I'm going to try to have on as a co-host to really wax about retirement plans. You don't pay me, the product does. And Shook, that comes back to you. That's a lot of how insurance people make money and how they build themselves and their products is you don't pay me, my company does. Well, guess what? Indirectly, you're paying it, and I'll touch on that. All right, so those are the account types, bank accounts, brokerage accounts, and retirement plan accounts. I'll leave it there for now. I think this covers most of what you all generally have or may have. There's other products and account types out there I won't be touching on, but I think what I'm hitting on today will cover the majority of things. So let's move on to investment products now. We'll start with stocks and bonds for that matter. So stocks and bonds don't directly have any fees in and of themselves. So stock is just a share of a company you can buy. It's a slice of ownership. And a bond is an IOU from a company where they will pay you generally interest and then repay the loan amount or the principal at the maturity of that bond. Neither of those usually have any direct fees associated with them. But you have to buy and sell them somehow. And that's where the fees may come into play. So the fees usually going to be applied at or by the broker through which you buy or sell that security. So as I mentioned before, brokerage accounts don't usually have a fee to maintain it. They may or may not have a per trade fee to buy and sell a stock or bond. Most stocks don't have trading commissions anymore. Most of the brokers did away with that within the last, I think it was like around the end of the year, give or take. But bonds, if you want to go buy a bond, there's almost certainly going to be a fee associated with that. It could range from, $20, give or take, if not more, depending on the bond. So you will have to go through a broker to buy or sell stocks or bonds, and that broker may impose fees, as we touched on before. But the stock or the bond itself doesn't directly have any fees. What if you want to buy mutual funds? I assume you've all heard of mutual funds. A mutual fund is just you invest your money pooled up into a pot. That pot then takes everybody's money and then buys a whole bunch of stocks or bonds or whatever inside of it. So you're buying a share of the fund, which indirectly holds, a whole bunch of individual securities. There's cost associated with. Just look at the comments here. Okay, prior to employers were small and the fund fees were high, all over 1%. Yeah, Pearl. So the fees of the funds themselves over 1% is high, but you may have also had additional plan fees that you paid out of your assets directly every quarter, every month, every whatever, above and beyond just the fund fees themselves. Separate account maintenance fees or something. Possibly. You may not know it if you never looked at your statement, and most people don't see this stuff or recognize it, but it's possible you paid more than just the fund expense ratios. So speaking of fund expense ratios, as I was saying, with mutual funds, it costs money for the companies that put together this pool of money to hire the people to manage it, to do the trading of the stocks and the bonds in it, to do the administration of the paperwork every year for taxes and stuff like that. So of course they got to get paid. and you've all heard of mutual fund companies. There's hundreds of them: Vanguard, Fidelity, Janus, T. Rowe Price, PIMCO, BlackRock. The list goes on and on, but those are just some of the big ones that come to the top of my head. So you got to pay them for the service of running and administering this fund. There's really sort of two categories of fees involved in mutual funds. One is what's called a sales load. That is plain and simple, it's a commission. It's a fee you pay for the privilege of buying or selling that fund. So I graduated college in 2000. When I first started getting interested in learning about finance, personal finance was late 90s. And lots of funds, mutual funds at the time, had these loads, these commissions. So let's assume it's a 5% load. If you put $100 into a mutual fund, well, guess what? Only 95 of those dollars actually get invested into the fund. The 5 gets paid, skimmed right off the top. Skimmed sounds nefarious, but that's basically what happens. Skimmed right off the top to pay basically a commission to the person who sold it to you. That's a sales load. They could be paid on the front end, like in this example, they take it right off the top, that 5%. Could be on the back end. If and when you eventually sell out of the fund, they'll then skim 5% off the back end of it. But that's a load. Thankfully, in the last 20 or so years, there's such a tremendous array of what's called no-load mutual funds, funds that don't have this ridiculous, you pay us for the privilege of buying this fund fee, that in my opinion, there's really no reason to have to consider buying a fund that has this sales load in it, because there's so many good options out there. I'd be hard-pressed to come up with a sample of a fund that's so unique, that's so magical, that it really can justify paying 5% right off the top for the honor of buying it. I have trouble digesting that. But lo and behold, there are still some fund families that charge these ridiculous sales loads that are still out there, and people still buy them. My view is they're not getting bought, they're getting sold. They're getting smooth talked by the broker behind it who's saying, yeah, this is good, whatever. And yes, they have to disclose they're getting this commission, this 5% commission, but it's kind of buried in there, and then they gloss over it and clearly don't dwell on the fact that only 95% of your money is going to work. The other 5% I'm taking. The point is, these funds still exist, and I don't know why, but they still end up getting purchased. So keep an eye out if and when you're buying mutual funds. There's no reason to buy a loaded fund, in my opinion. Look for stuff that's no load. So that's the sales load. The other one, which you can't avoid, is what's called the expense ratio. That is baked into the fund. You don't explicitly pay it yourself. You don't send in a check or whatever. It's just every quarter, typically, whatever this expense ratio is, and it's expressed as a percentage, whatever that is, that they take that out of your fund. It just sort of magically comes out. It'll show it on your, it doesn't even show it on your statement, I don't think. Just know the money comes out. So historically, the average expense ratio was 1%. Give or take. 2% was high, but wasn't uncommon 20 years ago. And that expense ratio covers a few things. It covers the management of the fund, the personnel behind it doing the deciding of what stocks or bonds to buy and when to sell them, and all the various overhead expenses of maintaining an office and the back office staff to run the reports and do the reconciliation of the trading activity, whatever. That's the management fee. There's also some random other expenses sometimes. I don't have a good example of what they are, but it's anything that sort of falls outside of that management fee. And then there's one that really tickles me in the wrong way, called the 12B1 fee. You may have seen it before. You probably wondered, what the hell is it? Most people are puzzled by it. So it's 12B1, 12 boy, B as in boy, 1. It's, I forget the technical, what they call it. It's for marketing and distribution charges, basically. So I'm trying to think about the best way to put this. It's kind of like you, the fund holder, by way of this 12B1 fee that's embedded in the fund's expense ratio, you're paying for that fund company to market and distribute, and basically to sell you and everyone else the fund. So like you're paying for the advertising that was done to sell you on that fund, is sort of one way to think about it. Part of that 12B1 fee could also go to the broker who sold it to you. So even though you may not have this explicit sales load commission that I just mentioned, that's not too common anymore, the broker who sold it or the company who sold it could still be getting a kick in fee somehow from taking a slice out of that 12B1 fee. And there's other things sort of buried in that 12B1 fee. Thankfully, as information is more prevalent and people are becoming more educated about this, 12B1 fees are getting reduced and or going away in many cases. but nonetheless, there's still lots of funds that have it. If you look up a fund's prospectus, which is its formal couple 100-page document explaining everything about it, it'll clearly detail all the fund fees, and you can see in there a 12b1 fee, and it'll break down how much of the total expense ratio is for management fee versus 12b1 versus other. So that's that. Now, what's common or what's typical for these fees? It depends on the type of fund you have, what its strategy is. Not to get too off on a tangent, but there's funds that are actively managed where the portfolio managers behind that are consciously and actively trying to pick stocks and bonds they think will do better than the average, better than the market as a whole. That's active management. There's a lot more time and effort and resources put into that than there are doing what's called passive management. Passive is just simply the fund is just trying to mimic the S&P 500, for example. They're not trying to beat it, not trying to do worse than it. They're just simply trying to replicate the 500 stocks that are in the S&P 500. So it's a much more hands-off investment approach. There's a lot less labor and research and other costs associated with running it. So if you have an active managed fund, fees used to easily be 1%. The expense ratio of that fund, the built-in expense that gets taken out every year, used to be in excess of 1%. Now, 1% is the high end, in my opinion, for actively managed funds. It's not unreasonable yet, but it's still fairly high to be 1%. Anything between, for an actively managed fund, as low as like 0.5% is pretty good. So somewhere between 0.5% and 1%, just anecdotally, is kind of the range you should expect for an actively managed mutual fund. Above 1% is probably higher than it should be. Below 0.5% is really good for active managed. Passive managed, the ones that just seek to replicate an index, Vanguard and others like it do it for a fraction of a percent, under 0.10%, under 0.1%. Some Vanguard funds, for example, are as low as 0.03, 0.04%. Fidelity, I think, actually has some zero expense funds that are literally zero ongoing expense ratio. Again, they're making money off of paying you squat on your cash, and they're getting paid on the back end in some ways. But Fidelity now, and others will likely follow, have funds with truly zero expense ratio. And those are the passive ones, again, that just seek to mimic the S&P 500 or something. It's not people trying to cherry pick, the stocks and bonds they think they'll do good versus not. So that's mutual fund fees. Just giving some comments here. Yeah, and some vendors forgive the sales load, though it exists. Not sure how they can, but they do. Yes, so for some funds that have sales loads, you can read in their prospectus or read online. Some of them do waive it. I'm not sure how and when and why. I don't know if they only do it when you raise a stink, or there's some other reason where they waive it for everyone, yet they still choose to say, we have a fee or we have a commission, but we're waiving it. Maybe they do that as a marketing technique, possibly, to be like, hey, look, we're giving you something. Well, guess what? You're not, because there's no reason to be attempting to charge those commissions in the first place, in my opinion. All right, David, people becoming more aware of fees explains the growth of Vanguard over the past few years. Exactly, yes. Fees matter, right? Control what you can. You can't control what stocks or bonds will do better or worse in the market. So my view is really kind of don't bother trying, especially when you're investing in U.S. stock market. There's thousands of people who make a career trying to filter the winners from the losers, and they're also good at it that they completely take away any possible edge anyone has, because there's so many people all trying to nitpick the same little bits of info that's kind of futile to try to actively pick winners from losers in big markets like the U.S. When you get into some smaller markets, some emerging countries, or certain types of bonds that are less traded, less people are analyzing them, then the case for active management starts to make more sense, where there is still pockets of information that you can uncover that the rest of the world doesn't know. But if you're talking about Apple, no one's got a leg up on Apple. There's thousands of people who make a job out of trying to cover every single thing about Apple. Guess what? You're not going to know anything that someone else or dozens of people don't know. So don't bother trying to think you're going to pick a winner. If you get Apple right, good for you. You got lucky. If you got it wrong, things happen. But my point is, my soapbox about active management is coming out here. I don't think it's necessarily worth it. So coming back to your comment, David, a lot of what Vanguard does, they have active management funds, but a lot of their funds are passive. They were the first one to create the S&P 500 tracking fund. Yes, their fees are rock bottom because that's their mantra. Keep it low, keep it simple, keep it passive and diverse. That's all I really need. So coming back to, as an investor, control what you can. You can't control what's going to win and what's going to lose over the long term. That's more or less a gamble. You can control fees, right? So why buy a fund that has an ongoing 1% fee per year when it may or may not do better than just investing in like an S&P fund that has 0.03% per year, right? Right off the bat, you're saving yourself almost 1%. You're better off by almost 1% every year, right out of the gates. That's hard to argue against, in my opinion. Before I hit these other few comments here, exchange traded funds. So mutual funds I just talked about. Exchange traded funds, loosely similar to mutual funds in that people pool up money into one big pot. That one big pot then goes out and buys hundreds, if not thousands, of individual securities, and you own a slice of that pot. I did a video on this, and I might do a live topic about it to dig into all the details about how and why they're different. So I won't get into it too much, but exchange traded funds are basically mutual funds, but they trade like a stock. So you buy them through a regular brokerage account as if you're buying shares of Amazon, Apple, whatever, it doesn't matter. And because you buy them like stocks, they usually don't have any per trade fees associated with it. And they don't have any sales loads because they're not sold by, mutual funds have what's called distributors, which is kind of middle people. The fund company will go out and sell to retail brokers to go sell to their clients. There's a whole chain of sales involved in mutual funds. So that's partly why they used to have these sales loads. ETFs, exchange traded funds, don't have any sales load. They do have an ongoing expense ratio, just like a mutual fund. They don't have 12b1 fees, again, because they're not marketed, they're not distributed like mutual funds, so there's a lot less cost associated with creating and bringing ETFs to the market. So their expense ratios will be smaller than mutual funds, all else equal, because there's no 12b1 fees, and then again, no sales load. And the management fees are typically smaller as well, but that's because ETFs are almost exclusively passively managed strategies. They just seek to mimic the S&P 500 or some other index. There are some ETFs that are now actively managed, and there's more on the horizon, but for the most part, ETFs are almost all passive. And again, passive has lower ongoing management fees because there's less buying and selling activity, so they can get away with doing a cheaper management fee in their expense ratio. So anyway, so exchange traded funds have expense ratios. There's no sales load. The expense ratio is usually smaller than that of mutual funds. All right. So let me just see now. There's a few comments here. Yeah, Brian Williams just saying Vanguard isn't necessarily the cheapest. Correct. Like I mentioned, Fidelity as an example, I know they have a handful of funds that are truly zero expense ratio. So right there, they'd be Vanguard by a few basis points. A basis point is 1/100%. So that their fees are better than Vanguard's in some cases by 0.0345%. Kathy, how do you compare a passively managed fund with zero net expense ratio and an actively managed fund that has a higher net expense ratio but a much higher historical return? Good question. So is it worth investing in the active management fund? The disclaimer on every single piece of investment marketing ever is the past is no guarantee of future results. So if you firmly feel that the actively managed fund will indeed outperform the index going forward, then sure, invest in it. Even if its fee is higher, net of the fee, if you know with certainty that actively managed fund will do better than the index, by all means do it. That's if you had a crystal ball. You don't. And maybe you do, I don't know, who knows. But most people don't have a crystal ball. And I don't want to open the can of worms here, active versus passive. This brings up a lot of heated opinions. No one's necessarily right or wrong. Not statistically, but research and time has showed that on average, the majority of actively managed funds do not outperform their benchmarks or whatever index they're trying to perform against, et cetera. So not to say that there can't be those that do win, but you don't know today which ones will be those winners. You'll know in the past which ones were the winners, but that doesn't guarantee they'll continue to be the winners. And there's lots of reasons for that. Some are those that do get on a hot streak, whether it was a hot streak or actual skill. investors are fickle. Everyone's going to flood to that which did well recently in the past. So a fund that had a really good 2 or 3 years, money's going to flood into it. Having to put that much more money to work may mean there's too much money to put to work. They have too much money to find those good opportunities that they took advantage of in the first place. So like an actively managed fund that does well may be its own self-fulfilling prophecy of not doing well in the future. I'll leave it at that. Historically, there have been people who are winners, like Peter Lynch of the Magellan Fund of Fidelity had a really phenomenal few decade track record, but that was decades ago. There hasn't been many people who have consistently beaten the market like he did during his run in modern times. So how do you compare the fee? It's tough to say. Again, if you know with certainty and you're very confident the active fund will do better even net of its fee, then sure, go ahead and pay that 1% fee instead of the 0 for the index fund. You'll know after the fact which one would have been or was the better decision, but hindsight's always 2020, unfortunately. So control what you can control. That's my view, which is the fee and taxes to a certain extent. Cody just adding a bunch of commentary here about fund share classes. Yes, thank you, Cody. I will leave that comment. Lauren, our philosophy, go passive with your investments and active with your career, not active with investments in your career field, but actually investing back into yourself to get more out of your career. Somewhat tongue-in-cheek, but it hits home. Yes, good philosophy. I enjoy that. Investing isn't just stocks and bonds. Investing is yourself. Your personal capital, your physical capital, your ability to earn wages is one of the biggest and best investments and biggest sources of money and income you'll make over your life. So yes, investing in yourself and your career is a great idea. Now, it's really hard to compare that apples to apples with investing in a mutual fund, but yes, to your point, I like that. The investments, keep it simple and passive. Your career, your earning potential, your human capital, definitely invest in yourself, whether it's increasing your skills or whatever makes you more marketable or better at your job to earn more. Good point. Thanks for that, Lauren. Okay, so moving on. So that was investment products. I'll leave it at that. Stocks, bonds, mutual funds, exchange traded funds. Let's now move on to insurance products. Yes. So let's start with life insurance. Most insurance doesn't have explicit fees that you, the policyholder, pays, at least not directly. So let's start with the basic term life insurance. You buy $1 million policy for 20 years, you're going to pay whatever, $600 a year. It depends on your age and your health and blah, blah, blah. Well, let's just assume it's $600 a year. The insurance company isn't sending you a separate bill to pay for their marketing expense, for their record keeping expense, for their cost of the actual insurance. No, you just pay premium every year. So there's no direct fee, and it's true for insurance people to say it's no fee for you to buy this policy, but like banking products, you're paying for it indirectly. The amount of premium you pay, only a portion of it goes to the actual cost of insuring you. The rest of it's going to pay for the slick marketing brochures that the company has and to pay for their overhead, which they have to do. I'm not it sounds like I'm knocking them, and I am arguably unnecessarily tough on insurance salespeople a lot, but they need to make their money, but I'll leave it at that. There's lots of times they bill things as no fee as like a big marketing pitch when there's still fees worked in there. They're not misleading you by saying no fee. If they were to say no cost, then I'd have to start slapping people. But it's true that a lot of insurance products are truly no fee directly. So that's basic term insurance. When you get like cash value life insurance, universal life, variable life, whatever, every premium you pay, again, behind the scenes goes to different pots. Some of it goes to your actual cost of insurance. When you have a policy that also builds up cash value, some of it goes into basically towards building up that cash value, sort of like a forced savings mechanism almost. And then some of it goes to the marketing and the overhead and whatever. Insurance salespeople make their money mostly, if not solely, off of commissions from products that they sell, whether it's term insurance or whole life insurance. Basic rule, and I don't sell insurance, so take it for what it's worth. I don't know this for certain, but this is what I've heard. Basic rule of thumb is the amount of commission an insurance salesperson makes is roughly equal to the first year of premium. So if you buy that $1 million term policy, like I just mentioned, and you're paying $600 a year in premium, the salesperson, you could expect he or she will get a commission check of about $600 for selling you that policy. So you're also indirectly paying for that commission as part of your premium. Again, you can't slice it and dice it and pick it apart. You can't choose to say, give me a smaller commission policy. It is what it is. Just know that it's there. Like this goes to Brian Williams' comment. You don't pay me, the product does, or my company does. That's the selling line from insurance people, which is technically true on the surface. You're not outright paying that person, but your premium is higher than it otherwise would be because there's this commission check, coming out and getting paid to the person who sold it. And cash value is the same way. So I don't know if the rule of thumb is the same, that the commission is about 1 year premium. I believe it is, but I can be wrong. But the commissions are much larger on cash value policies, which the skeptic in me says not coincidentally that's one of the reasons why insurance salespeople will often eventually try to lead you down to having the discussion of converting your term life to a cash value policy or selling a cash value right off the bat. I did an interview at a large insurance company back in college, and I got turned off by it and gave up on the idea of being an advisor at the time because of this experience. But the people I spoke with, interviewed with, were saying like it's like the golden ticket. Selling this cash value life insurance policy, that's the home run. You can sell these term life policies all day. It's a lot of work for not a lot of payout. You sell this cash life, boom, you get a big fat check. That felt dirty to me, so I gave up on that idea of being what I thought an advisor was. And then fast forward now, 20 years later, here I am doing it in a different way, advising in a different way that feels right. But I'm not sure how I got off on this conversation, insurance. So just know there's commissions getting paid, indirectly out of your premium, but you're not directly paying for that. It's accurate when insurance people say that. What else do we got here? Yeah, Cody says commissions on insurance can be paid upfront, meaning first year, or trailing, which is spread out over multiple years. That's also called trails in the industry. You may sell a policy and get paid out your commission on it for like 10 years or so. Pearl, Andy, advisors we talked with all charge an investment management fee as a percent of assets. Do any advise? I know where you're going with this, Pearl. Hold on, that's at the end of my 37 minutes already. I'll definitely get to that. Advisory fees are at the last part of this discussion today. Shook, what about index universal life insurance? Is there a not tax advantage and loan advantage like an umbrella insurance? Good question. Let me not address that because that's going to be a huge can of worms, talking about the tax and the other benefits of life insurance. Great question, but I'd rather table that for purposes of today. I have a feeling we're going to definitely go over time with this fee topic, but good question, Shook. Thank you. Okay. All right. So that's life insurance. Next are annuities. Dun, dun, dun. I will be doing a live all about annuities in 2 or 3 weeks, I think. So I'll get more into it there. There's 3 kinds of annuities. Let's see if I can do this quickly without getting too off the rails. One is just a basic income annuity. Think of it as a pension, a regular pension. You hand over a lump sum of money to an insurance company. In return, they give you a guaranteed stream of income payments for the rest of your life until you die. Now, there's different ways you can structure it. Sometimes you can say, have those payments last at least 10 years. If you die sooner, you can have it such that if you die soon, the leftover goes to your heirs or whatever. But let's just assume it's a basic pension. You give money, you get a stream of income for the rest of your life. There's no direct fees with that. That's a factual statement. But it's like banking products and life insurance. The company's still making money. Obviously, they have to. You are not directly paying for it. It's worked into how much they pay you. So you give $100,000 today, depending on your age and whatever, you can expect to get, I don't know, $5,000 a year, maybe less, maybe more, in your income payments. Now, had they not taken out some for their fees and for the commission of the person who sold it, maybe your payments would be $5,500 a year, right? It is what it is. So you are ultimately paying somehow. It's worked into what you're getting and what you're not getting. There's nothing you can really do about it. So yes, these basic income annuities are no fee, but just keep in mind, like banking products, the insurance company's making money off of it, and they should, right? Next is indexed annuities. These are squirrely. They're cool products, but they're really complicated. One of their big selling features is no fee. Again, technically true. You're not explicitly paying anybody anything for this fee. You're handing over money. It grows. it grows based on some index that it references, but it usually doesn't grow as much as that underlying index does. So what the insurance company does is if the S&P went up 10%, they'll only pay you 5% on your contract. So they're keeping that difference for themselves. It's basically a spread, like how banks make money. They pay you less than what they make on your money. Insurance companies effectively do the same with annuities. They're paying you out less than what they're earning on using your money. So yes, index annuities are almost always no fee. That's an accurate sales pitch. But there's lots of ways that they trim and slice and dice to pay you less than what you otherwise would get if there wasn't a commission behind it being sold, or if there wasn't all the overhead and stuff like that. And again, these companies they have overhead, they need people. Do they need the amount of slick marketing, TV campaigns and magazine campaigns? That rubs me the wrong way, but yes, they need to pay for that stuff nonetheless. So sure, they should be making money. And then finally, variable annuities. They do have explicit fees. These are different from the plain vanilla income annuities and the index annuities. Variable annuities actually have you invest in mutual funds or pools that reference mutual funds, sort of. There's outright fees that are deducted from your account for what's called mortality and expense charges. That's the cost of insurance or the cost of you eventually turning on your annuity to turn it into income. That's a fee, and that ranges from 1 to 2-ish% per year. There's also sometimes like general just administrative fees, which could be $25 or $50 a year or something like that, or a percentage like 0.25% of your contract balance every year for administrative fees. Here's where the fees really get fun. If you add on what's called riders, which are just extra options you can bolt onto your annuity, riders come in additional fees. With variable annuities, most or commonly people will add on an income rider, which is a guarantee that you can withdraw certain amounts of money every year for the rest of your life. Those riders cost anywhere from 1 to 2%. So now do the math. You're paying, let's call it 3% in ongoing fees, and that doesn't include the expense ratios that are built into the mutual funds in which your variable annuity invests. And in my experience, from the variable annuities I looked at, the insurers don't typically give you a menu of low-cost, fee-conscious funds. It's stuff in there where the whole chain of investment professionals and whatever involved is making a little bit of money off this. So the expense ratios in the mutual funds I've seen in the variable annuities I looked at is commonly around 1%. Sometimes a little lower, sometimes a tad higher, but it's upwards of 1%, which again I think is higher than it needs to be in many cases. So in addition to paying about 2 to 3% in regular fees for the variable annuity plus your riders, if you add it on, you're also paying, in my opinion, higher than normal fund expense ratios built into the funds in which you invest. So some variable annuities, it's not uncommon to be paying about 4% fees per year in that annuity, all said and done. I'll leave it at that. That's annuities. And again, all annuities earn commission. I forgot to mention this, surrender fees. So a variable annuity, like I just discussed, something that has like 4% fees, has income riders, has bells and whistles. It's not uncommon for the commission on that to be about 10% or up to 10% of how much you put in. So if you buy an annuity for, let's call it $200,000, one of these variable annuities, the person who sold it gets a commission of like 20 grand, roughly, maybe a little less. And that could be all paid right up front, or it could be stretched out. Often I think it's paid up front. So annuities have what's called surrender fees. Your money is locked in for 5 years, 7 years, 10 years, whatever the minimum life of the contract is. They usually let you trickle out like 10% per year of your money. But if you take out anything more than that, there's going to be a penalty, a surrender fee, a withdrawal fee. And that could range from anywhere from, I've seen some high single digits, 7, 8, 9%. And then that fee percentage trickles off over the course of the contract life. So when you get to 10 years, there's no fee to take it out at that point. But the reason why, one of the main reasons why they have that surrender fee, why they want you to, or entice you to keep your money locked up in this contract, is because they paid, potential 5 to 10% of the contract value as a commission to the person who sold it. You don't directly pay that, that's true. But the insurance company needs you to stay in that contract long enough for them to make enough money to recoup that commission, that fat commission they paid. So that's why, one of the reasons why they have these surrender charges. If you do pull the ripcord in and get out early, they're going to hit you with a fee to basically make you sort of reimburse them for the commission that they paid the person who sold you the annuity in the first place. Anyway, so that's annuities. Other comments here. Lauren, index annuities that spreads, participation rates, etc., but also don't receive the indices, dividends, in their credited rate. Yep, that's exactly it. And Shook says, what does that mean? So, Shook, I assume you're asking about Lauren's comment. Where are we at time-wise? 45 minutes. So I'll go over all this in more detail on my annuity one in a few weeks, but yes, index annuities at a high level. Participation rate means if the underlying index goes up 10%, you're only going to get value for 6% or 5%. That's how much of the upside will you participate in. So it's going to be something less than 100 in most cases. So they make money by keeping the difference. A cap rate. A cap rate is something that you'll any given year, no matter how high the index goes, will only give you up to 4% a year, 5% a year. That's a cap rate. A spread's basically a fee. They don't call it a fee, but it effectively is. A spread is if the index went up 10% or whatever amount the index went up, we're going to take 2% right off the top. So if it went up 4%, we're only giving you 2. If it went up 10%, we're only giving you 8. That's called a spread. That's another way they can sort of keep some of the difference for themselves. And they don't pay dividends. It's a little more on the technical side, but yes, often when an index annuity references the return of an underlying index, they only reference a change in price of the index. They don't give you credit for whatever dividends that index paid. Those dividends are extra return that you would otherwise get if you actually invested in that index. Instead, the insurance company sort of keeps that dividend for themselves and pays you out only the change in price. I'll leave it there. That's quite technical. But as Lauren pointed out, these are all ways that insurance companies make some money on these index annuities. It sounds dirty, but it's not. They need to make money. How much they make and whether it's too much, that's a whole different story. But there's a bunch of levers they can pull to make money and still call the product no fee, which is technically accurate. There is no fee to buy and stay in most of these indexed annuities. Good. Linda, what's our best options for income and some growth? That's well beyond the topic of tonight's discussion. Great question. You can email me offline if you want to further discuss, but that's a big can of worms to say what's best for you in your situation. There's way too many options out there. And all these things we're discussing, whether it's a stock, a bond, a mutual fund, an exchange traded fund, an annuity, life insurance, none of them are inherently good or bad. They're all just products. They're all tools. They all have their time and place where they make sense, sometimes some more or better than others. But none of these things are inherently bad. Now, some people will tell you otherwise. People like Ken Fisher, if you've heard him, says, I hate annuities and you should too. That's literally his slogan. We know where he stands, but he makes all his money on charging people percent of assets. So clearly he wants people to invest as opposed to buy annuities. So he's as biased as anyone there is. People who sell annuities love them, obviously, because they make a lot of money on them. So they're sort of biased towards selling annuities versus not selling annuities. Doesn't mean any of these things are good or bad. They're a tool in a toolbox. They all have their place for the right person in the right set of circumstances. So Linda, without knowing anything about you, it's impossible for anyone to say what's best for you. And what's best for you is going to be different than what's best for your neighbor or someone else. Good question, though. All right, so that's insurance products. Let's move on real quick to lending products. I don't want to spend too much time on this. Lending products, basically credit cards, they have interest rates, not uncommon for them to be 15, 20%. Mortgages, when you get a mortgage to buy a house, you pay origination fees. That's the fee for the bank to do the work in underwriting, to approve you, to the paperwork, the back office work, all that stuff, the application process. That's an origination fee. Obviously, you pay interest on a mortgage. Now 30-year mortgages are like 3%, if not less. That's a fee. Potentially points. I don't want to get too far into this, but points are ways. It's basically additional lump sums of interest you can pay at the inception of the loan, like pay a big nut of interest now to save yourself some ongoing interest rate in the future. That's another form of fee. That's how banks make their money in lending. And then home equity loans and lines of credits are loosely the same way. They make money off interest each month, and then they have origination fees involved. HECMs, reverse mortgages. HECM is HECM. It stands for Home Equity Conversion Mortgage. Increasingly hot topic in the retirement planning space. People who sell them love them, and they do have some value. They got a bad rap, and rightfully so, when they first came out a while ago. But the federal government, the FHA, Federal Housing Administration, has really sort of wrangled them in and put some standardization and controls behind it. Shouldn't be the first option for people, but it's an option nonetheless. It's a way that you can tap the equity in your home to get income for yourself, and you don't need to repay it so long as you're living in your house and you properly maintain it and pay your taxes and whatever. It's a good way can be a good way for retirees to unlock the equity in their homes and enjoy it and spend it and use it, as opposed to, die with $500,000 of equity tied up in your house that you didn't get to enjoy. I won't say when it's good or bad. Again, it's not right for a lot of people, and it definitely shouldn't be the first option that you come up with when trying to figure out how to generate retirement income, but it's an option nonetheless. The reason why I bring it up is just to touch on fees, because we're discussing fees tonight. So they have origination fees as well that range from $2,500 to $6,000 to enter the loan. And they have monthly interest like any other mortgage does. They also have additional interest called MPI. What is it? Drawing a blank on the name. MIP, it's Mortgage Insurance Protection or something. That's unique to these reverse mortgages, and that's you pay another 2% of your loan up front plus 0.5% per year ongoing, in addition to your regular interest, that you pay for this mortgage insurance protection. That's unique to these reverse mortgages. So point is, reverse mortgages are not cheap ways to get equity out of your house, but they do have a lot of flexibility. And if you don't have plans on leaving your house to your kids, or otherwise are okay with burning through the equity in your house and living off of it, or doing whatever with it while you're alive, then maybe reverse mortgage is something to consider. All right, I'll leave it there for the lending products. Now let's move on to advisory fees. So we're done with the product side of today's fee discussion. Let's now talk about advisor fees. I could talk for a couple hours about this. I'm trying to think of the most concise way to put this. So there's really people who give financial advice for compensation need to fall under one of three buckets, if not multiple of the three, because you need to be regulated in order to give advice for compensation. I'm not talking about your uncle who likes to tell you stock picks and things he knows what he's talking about. He doesn't need to be regulated. If you're doing it for money and you're putting yourself out there in the world as being someone who gives financial advice for compensation, you need to be regulated in at least one of three ways. One is as an investment advisor. One is as an insurance salesperson, and two is as a securities salesperson. And by salesperson, I mean someone who is able and legally licensed to sell a product for commission, is kind of the best way to think about it. So securities are stocks, bonds, mutual funds, whatever. Insurance is life insurance, disability insurance, annuities. So security salespeople, insurance salespeople, investment advisors. Investment advisors cannot sell product. They're called, they get fees only. They get fees most commonly by deducting, assuming they're actually managing your investments. They take fees by most commonly deducting a percentage of your assets. Historically, it's about 1% of assets under management. So do the math. If you have $500,000 that an investment manager is overseeing and they're charging you 1% of assets under management each year, you're paying $5,000 a year. And then scale that up. If you have $1 million, you're paying $10 million a year. If you have $2 million under management, you're paying $20,000 a year. Now, advisors, it's not always 1% for everybody. And even for those that do charge 1%, it's not 1% on everything. It'll be 1% on, the smaller account sizes. There's often tiers or breakpoints such that once you get over $1 million, it drops to 0.9. And then over $2 million, it drops to 0.8 or whatever. So the fee percentage often comes down as your account size goes up. But nonetheless, the more money you have, you pay more for the honor of having accumulated a lot, whether or not your investment needs are any more or less than the next person, or your overall financial life is any more or less complicated. Generally speaking, your fee goes up simply because you have more assets. That's the percentage of assets under management. This is its own hotly debated topic in the industry and amongst clients and consumers. Not only is 1% of assets too much or too little, but is the percent of assets under management structure even appropriate anymore? I lean towards it's not. It still has times when it works and works well, but investment management has become increasingly cheap easy and commoditized to do and do well because there are such good diversified products, exchange traded funds, mutual funds that have really low fees, that have really good underlying diversity, that are really easy to buy and sell. It comes back to the active versus passive management discussion. I don't feel there's value to be added by trying to actively filter out winners from losers, at least when it comes to big trading markets like US stocks and most other global market stocks. I don't think anyone's going to have a leg up, sustainable leg up, to try to pick winners from losers over the long term. So keep it cheap, keep it simple. So that comes back to, is 1% of your assets too much to charge? Or even percentage in general? Because again, someone that has $4 million will be paying potentially 4 times more than someone that has $1 million, even though that account almost certainly isn't going to be 4 times more work or 4 times more difficult to manage. That's how the fee structure works, and I feel that's inherently flawed in many cases. But it is what it is. Not saying it's right. I'm just saying it may make sense, it may not, depending. How do you make it as soon as possible? Dan Trainer, how to make up 1%? Seems impossible. Not quite sure what you're asking, Dan. If you can elaborate, I'll try to respond. But anyway, so going back to the 3 forms of advisors need to be regulated as investment advisors, insurance salespeople, or security salespeople. Those that are investment advisors, in addition to managing investments, they can also give just general broad-based financial advice. They don't need to manage your investments. They can if you want them to. But if you just want to go to someone for a handful of hours of their time to discuss some financial stuff or put together a financial plan, an investment advisor can do that. In that case, it wouldn't make sense to charge a percent of assets, especially if they're not managing your assets. In that case, they can charge like a flat fee. Say, like me, for example, I usually charge for my one-time financial plans. Standard fee for a married couple is $3,000, one-time fee. Potentially more if you're a really complicated scenario, but that's sort of my standard rate. Just to put a plan together, don't need to do management investments. Just pull together your financial life, make recommendations, discuss it, you can go on your way. So you can charge that way. You can charge just a flat standard fee. Some people also that are registered investment advisors that give financial advice will do hourly. You can call someone up and say, hey, I just need to run something by you for an hour or two. Can you charge me for it? And maybe their hourly rate's $200, $300, whatever. But they can do that. You don't need assets to be managed. You don't need this $3,000 plan. You can just simply do it hourly. So those are in the investment manager umbrella. Lots of ways to charge. Most commonly is managers would require you to have assets to manage so they can charge you a percent of it. It's lucrative to do it that way. And frankly, to be fair, in the past, there wasn't this flat fee idea and there wasn't this hourly fee idea. They didn't really exist. Or if they did, they were so few and far between that they were hard to come by. Most advisors will simply, you need at least $500,000 for me to manage, for me to talk to you. I'll charge you 1% on it. I'll manage your investments. I'll throw in some financial planning and other advice, and we'll call it a day. That was the historical model. Things are thankfully changing. There are more people that do flat fee just for advice or hourly fee just for advice. But tying it back to all those people will be registered as investment advisors. The next two, I forget what 3 fingers I had up. I think it was these 3. So that was investment advisors. Insurance sales folks. They make money from selling insurance products, full stop. They may also separately have an investment manager registration so that they can manage your investments, but often it's not uncommon. Insurance salespeople will be just insurance salespeople. Now here's where things get weird. They're licensed and regulated under insurance regulations, not investment management regulations. But their regulation allows them to give other financial advice so long as it is quote unquote incidental to the sale of their insurance product. So that's how and why you go to an insurance salesperson who calls himself or herself a financial advisor and say, hey, I just inherited some money, or hey, I got this 401k I'm looking to roll over. Can you discuss with me my options? They can get into other aspects of your financial life, but ultimately under their regulation, all that other advice needs to be incidental to their product being annuities or life insurance. So not coincidentally, more likely than not, their answer is going to be, yes, you should put this in an annuity, or yes, this cash value life insurance policy is what's best for your assets here, which makes things really muddied. So that's insurance salespeople. And I like to think about it like this. it's not an entirely fair analogy, but when you have a physical ailment, a health ailment, you've had a headache for a week, you don't know why, it's not going away. Who do you go to see to get advice? You go to a doctor. A doctor is legally required to act in your best interest, tell you unbiased advice that's best for you and your circumstance, etc. If he or she feels a certain procedure or prescription is right, then they'll tell you, I think you should go get this or buy this or whatever. That's a doctor. If you had a headache that won't go away, you're not going to go to a pharmaceutical sales rep to diagnose you and make recommendations of what you should do to treat it. Because guess what? That pharmaceutical sales rep, you go with a headache, you may walk out with their latest and greatest malaria medication or something, right? Sure, it'll cure your headache, but it's doing a whole bunch of other stuff you may not need that might not be right for you. It's going to cost you a lot, but guess what? It's suitable enough, it's close enough, boom, I'll sell you the product. Now, the reason why I say it's not a fair analogy is because there's legally a sharp delineation. Drug salespeople cannot give medical advice. You cannot practice medicine. We all know that. No duh. So that's not a fair example. But in the insurance and securities world, insurance salespeople can give financial advice. Securities brokers who sell mutual funds and stocks for commission can give financial advice. In both cases, so long as the advice is incidental to the sale of their product. Is it right? I don't know, but that's the way it's always been. In the medical world, you cannot do that. You have to go to a doctor. In theory, the doctor is acting in good conscience. The doctor is not in cahoots with the pharmaceutical companies, in theory. He or she needs to give you the best recommendation for what's right for you. If you go to the pharmaceutical sales rep, they wouldn't. They're going to try to sell you a product. That's sort of the same analogy to think of with going to an insurance or a salesperson or a security salesperson for financial advice. They're going to end up, don't be surprised if you walk away with one of their products, is what I'm saying. All right, now that I threw shade on the entire insurance and brokerage industry, what else about fees, advisory fees? Right, that's what I wanted to say. So is that really advice? I don't know, and this is where I have a beef with the financial services industry and its regulators. There's zero restriction or regulation around titles financial professionals give themselves. The word financial advisor, financial planner, wealth consultant, retirement specialist, retirement planner, whatever. Anyone can call themselves any of those things. It doesn't matter if you're licensed, registered, or not. There's zero restriction around that. Some states, thankfully, I think it's either Iowa or Indiana, one of them with an I, does take it upon themselves to be stricter than the national registration regulation. So let's assume it's Iowa. I think it may be. They don't allow insurance salespeople to call themselves financial advisors because they feel it's misleading. I'm 100% in agreement with that. You sell insurance, you don't give financial advice, right? Let's draw the line there. But elsewhere, outside of that state, and whatever other states don't have that regulation, you can call yourself financial advisor even if you're just a product salesperson. And that's why I got sort of hoodwinked when I was in college. I wanted to be a financial advisor. I interviewed for positions called financial advisor at the large household insurance and brokerage company names you all have heard of, and was really disgusted at the sales culture. It was all just make a bunch of calls, give me a list of your family and friends. Selling this cash value life insurance is a holy grail of products to sell. Contests and sales trips and vacations for who sells the most. Like, that's the sales culture. That's disgusting. That's not financial advice. But unfortunately, people can wear that hat and call themselves an advisor because the term advisor isn't restricted or regulated in most states, at least. That was a big tangent. Sorry about that. Anyway, so that's not real advice in my opinion. Real advice is going to be from people who are registered as investment advisors, whether they manage investments or just do financial planning or other one-off advice for a flat fee or an hourly fee. That's that. As far as what fee is typical and whether or not you get value for it when you're paying like a percent of assets, yeah, that all depends. So again, the standard is usually about 1% of assets under management. Is that too much? It depends what you get for it and how much total assets you have. So the scenario I don't like is where, let's assume you have $1 million of investable assets. You go to an advisor who charges 1% of assets. You're paying $10,000 a year for working with that person. Let's assume there's someone else has $2 million. Their life is identical in every aspect to yours. There's no other forms of complications or differences other than they have twice the amount of assets as you. Guess what? That person's going to be paying $20,000 a year, whereas you're paying 10. Chances are you're getting the identical service or close to it, yet the person who has had the hard work or the good fortune or whatever of having more money is going to pay more. Is that fair? I don't think it is. Most of the industry charges that way. Whether or not it's too much, that's up to you. I don't like to use other people's quotes, but this one I really like. I think it was Warren Buffett who says it. Price is what you pay, value is what you get. So don't necessarily get hung up on the $10,000 or $20,000 a year you're paying. If you feel you're getting that much value or more, then it's worth it. Now, it's hard to quantify that value. You can't just simply look at, when it comes to investment management and investment management only, the logical response is, well, did you beat the market for me? If so, then you potentially earned your fee. Sure, I sort of get that. But coming back to me, and I don't feel anyone can continually beat the market, so don't bother trying. Investment management isn't the real value add in working with an advisor. As you all hopefully picked up from being in taxes and retirement for a while, there's so many other things to your financial life that need attention and could really change your long-term financial outcome. There's tax implications to everything. So someone who focuses on tax planning, getting Social Security right, getting you into or out of annuities that are right or wrong for you, making pension decisions, making housing decisions, helping you refinance mortgages. These are all areas of tremendous value an advisor can add. So if you're going to an advisor who's only just playing with assets and probably not beating the market over the long term, and they don't really do any planning other than do some back of the envelope math, like if you save 50 grand a year, get to $1 million, that'll last you 5 years, good, whatever. That's not real financial planning. If that's all you're getting, chances are you're paying too much. If you're paying 1% of AUM, unless you only have $20,000 under management, then in which case you're paying $200. That's a steal. But assuming most people that are near or in retirement have $500,000, $1 million, if not more, 1% of AUM is not the right way to do it. What I do for what it's worth is a flat fee, and I try to key that off of what's the complexity, what resources are going to be involved in servicing you. Whether you have $1 million or $3 million, you're not necessarily 3 times harder or more work. So let's come up with a flat annual fee that's sort of fair for both of us and should cover the amount of work and resources needed. I don't want to make this into a marketing pitch, so I'll stop there. But percent of assets may or may not be what's best for you. It depends what you want, what you need, what you're getting, how many assets you have. It's not as simple as I don't mean to badmouth the entire model blindly. It has its merits and it does work in a lot of cases for a lot of people, but it's not always the best answer. So I'm done talking and ranting. Sorry, this sort of turned into a rant at the end, but let me go through comments here. Okay, so Lauren gave reference to the SEC site and the FINRA site are good places to look up advisors and brokers. Yes, definitely. Anyone who's registered with the SEC or any of the states as an investment advisor, or with FINRA, which is where all security salespeople will be registered, you can find them on one or both of those links that Lauren gave. They will be on there. If they're not registered with either of those places. Insurance people are not there. So people who are only registered and licensed to sell insurance, you're not going to find on SEC or FINRA site. Insurance, you need to go to each respective state that person sells insurance in. You need to find that state's, it's usually called the State Insurance Commission or something, find their website, then you can look up if that person is duly registered. Benjamin, you mentioned you typically charge about $3,000 for a full financial plan. You also mentioned a 200-hour fee. How much time do you typically take to develop a full plan for someone who is already schooled on the basics? Good question. Yeah. So again, not to make this about me and my fees, but my hourly fee is actually $300. So yeah, do the math. I figure it takes about 10 hours per financial plan for a couple, which is why my flat annual fee for a financial plan is $3,000. There have been times I've gone over. Sometimes I get a little wordy and elaborate in discussing things. So, it ends up being more than 10 hours of my time. but so be it. I don't want to bill people like a lawyer where I start a clock every time they call, or I'm doing something, because that'll disincentivize people from ever wanting to talk to me, obviously. So I just keep it a flat agreed upon fee. If someone's well schooled in the basics, I've had calls with people where they were exceptionally schooled in the basics and already did their own detailed plan, and I've said, frankly, you don't need me. I'd be happy to work with you, but I don't think you're going to get the value out of it. I don't see me adding much above and beyond what you've already done. So in that case, I have, and some of you may be on this, maybe not, but some of you are in this group I've had calls with and said, I don't think I'm going to be able to help you, or it's not going to be worth your money. So in that case, it depends, Benjamin, whether or not we would actually move forward. Cody, yes, broker check, thank you. I see people talking about investments here. Good. I'll let that be. That could be its own can of worms to talk about investments and strategies and what to do, what not to do. Cody talking about, yes. So Cody Garrett, tax efficient retirement income distribution strategies are a must if you use an advisor. Make sure you work with an advisor who knows your whole financial landscape, not merely an investment manager. Exactly. Unless all you want is someone to pick and choose what investments to buy and sell on your behalf. That's all an investment manager does, pure and simple. The real value is in the rest of the planning, especially when you're in or near retirement. Investing for retirement is relatively easy, or at least it's the easier of the two parts. Not simply, but you spend less than you make and you invest the difference wisely. Keep it cheap, keep it simple, keep it diversified. Where things get complicated is once you hit the crest of the mountain, the peak of the mountain of retirement, and now you need to figure out, I've saved all this money, how do I best withdraw it? And tie into it, how does Social Security come into play? How do pensions come into play? How does healthcare, long-term care, Medicare, housing? That's the real value in retirement planning. And like Cody said, that's what your advisor should be doing. If you are in or near retirement, someone who's just picking investments and giving you some kind of half-ass planning on top of it, that's not worth your money, in my opinion. Clearly, I'm biased because I do retirement planning, but that's my view on it. Pearl K, quarterly fee for AUM can be the biggest expense in retirement, so looking for an alternative. Yes, good point. Jackie, this was great. My first live with you and worth every minute. Thank you, Jackie. I appreciate that. Glad you can join. I'm glad you found it valuable. Andrea, it's hard to find an advisor who will also give you tax strategies. Wink, wink. I do that. There are others that do that, not just me. There are many people that do. You have to dig to find them and vet them out to see the ones who actually really know tax as well. But in my opinion, taxes more so than investments is one of the bigger value adds, because again, there's tax implications to virtually every single financial aspect of your life. Investments have since become cheap, easy, and commoditized to do and do well. Taxes require a lot of knowledge, a lot of work, a lot of cross-sectional analysis of every part of your life. That's the real value add, in my opinion. It's not what you get, it's what you keep. So what if you're in 10%? If you have to pay 30% of it in taxes, that's not as good as paying 20% of it in taxes. So, let's focus on getting you to keep more. Earning a lot is important too, but, keeping as much of it as possible is equally, if not as important or more. Good, just looking, Ileana, check out his YouTube channel. Good stuff, thank you. Yes, clearly I'm biased, but yes, I think my YouTube channel is good stuff. It is called Retirement Planning Demystified. For anyone who's interested, youtube.com/retirement planning demystified. Thank you, Ileana. All right, looks like the rest of the comments are done. So thank you all. I apologize for going 13 minutes over. I was really amped up about this, as you can tell. Hopefully you all got a lot out of it. Hopefully it was, I'm sure some of it you already knew, but the rest of it hopefully was eye-opening, maybe in a good way, maybe in a bad way. But either way, I hope you got something out of it. So that's it for today. Again, next week might change. Currently slated to be all about healthcare premium subsidies, ACA tax credits. Maybe changing to be a co-hosted special guest next week. I will inform you all if and when that gets confirmed. That's that. All right. Thank you, everybody. Have a good week. I will see you next time. Take care.